Good morning, everybody. Welcome back to the Opportunistic Trader. We're joined now on Thursday, October 4th. Thursday, we get the inventory figures from natural gas. We're joined by Brynne Kelly of the Fundamental Angle. Brynne has run some of the largest merchant energy trading desks in the world, and we hear from her every Thursday after the energy natural gas report to get a breakdown of what's going on. And it's been very volatile lately. How are you, Brynne?
Doing good, doing good. It's been a fun week in natural gas.
Yeah, so we got the natural gas inventory report, and we were trading 325 as the overnight high, and then on a spike after the release, we traded down to 312.90, and this is in Novi Nat Gas, and now we're back to 318. So what were the figures?
Yeah, so let's take a look at it. The expectation for the week was around 93. I always just go by what the ICE EIA storage futures, the weekly futures closed at the night before. So, I'd seen ranges between 85 and 98, but let's call it 93. And the number came in at 98. So just from that's a more bearish number than this week, than the expected, you could, I guess you could say the market's reacting to that from a sell-off standpoint. But as I keep saying every week, the picture is still the same, as far as being below the 5-year averages. We did inject in the South Central this week, so that's good. It was a little bit more in line with maybe the last few years, but still below the averages. The big injection really was the East and the Mid-Continent. That's where we kind of had what might have put us a little bit over the top. And then I'd like to take a look at, year to date, what injections look like by region. And in 2018, you can see that it really still is the South Central from an average or, year to date injections. Summer to date, we've put in around 211. It's hard to say, though, because the last few years, that's been kind of operated a little differently since we've started at such full levels at the beginning of the summer. They just haven't needed to put as much in the ground. So it's actually more relevant to look at 2015 or 14 averages when you're comparing these numbers, because that is more in line with the starting inventory levels we had this year, which was around, I think, 1335 or 1400. Whereas in 17 and 16, I think we started the season with well over 2000 BCF. So it's a little, the 5-year averages, it almost would look worse if you took the last 2 years out. We would actually look even more behind in the game here, in and around the Henry Hub area. So I can see where the initial reactions to a number would be, wow, that's bearish relative to expectations, sell. However, the overall picture hasn't changed. So if you want to take a look at sort of this storage season versus the 5-year averages, like I said, we started this year at 1335. If we use our end of inventory futures, which expire, like I said, November 2nd, those went out last night at 3260. So that would imply that we would inject 1925 this summer compared to the 5-year average summer injections, which are a little over 2100. So we're below the 5-year average by about a BCF a day. And then if you go from there, where did you end the summer inventory wise? And then how much did you draw throughout the next winter? And all I can use is what the market is implying for futures. So if you look at the end of winter inventory futures, they're sitting, and they have been sitting at 1410. So let's just pretend that that's the real number. That would imply a winter drawdown of around 1850. And the 5-year average drawdown is a little, almost 2200. So that's a difference of over 2 BCF a day. And that's where sort of the issue is, right? We put in less than a B a day compared to the 5-year average. And, we could draw more than 2 B a day, this winter compared to the 5-year average. And so it all comes down to ending inventory balances. And then comparing just by region where inventory levels are. The green on this chart is current. It's this week, this year, compared to, the last 5 years. And again, we're same story. We're below. It's more apparent in the salt and non-salt areas. And the thing that's interesting about this market right now is that, October isn't usually a strong demand month from a weather standpoint. It's other factors that come into play. And so the cash market gets to be a very big influencer of the futures contract, because the first futures contract on the board is a winter contract, and it's November. And what we saw this week was, and maybe I'll just go back down to that, we had a pipeline issue on the Tennessee gas pipeline. They were doing some repairs that turned into a force majeure, and it's up and around kind of northern Pennsylvania. And it started on October 28th. And you can see, I have in the corner here, cash prices at TechCo M3, which is one of, the delivery hubs up in the Northeast, and this Lady Hub as well. And then Henry Hub and the Houston Ship Channel. And, the cash prices at Henry Hub were already getting strong. Partially they were, it's coming to the end of the summer, and they need to start bidding for storage barrels or MMBTUs.
So do you think that's really what the crux of this large move that we've seen over the past 7 or 10 days?
Let's see. So it's overall a bullish picture, but the constraints really supported the cash markets, and that carried forward through to futures. And maybe we moved faster and farther than we normally would have. When you all of a sudden see October cash trading at 325, the market starts to look at the November contract, and it starts to look like a bargain. So July and August cash prices tend to not impact the winter strip as much because there's still so much time, but they will impact now that here we are in October cash. And so it's a matter of how close we are to the winter. So yes, by closing in some of that production up in the Northeast, there was less gas flowing out of there into some of the Southeast locations. And so it exacerbated the problem. And that's what always happens in October. Problems get exacerbated. It's either a hurricane, it's nuclear unit outages, planned maintenance, it's production problems, pipeline issues. It's a month of maintenance, and things tend to become, or they're more exposed to become problematic, and that's what happened. So, and I bring that up because, be careful to take this as the beginning of an uptrend for the whole winter. I think it's the beginning of volatility.
And you're saying also seasonality, and I think Adam Collins also pointed that at October seasonality for nat gas.
Yeah, and you always have to take some of these seasonal things in context with where you're at this year, right? So seasonal might have meant something different when we were sitting at almost 4 TCF in the ground, right? Versus when we just barely got over 2 TCF in the ground. So there certainly is going to be an underlying cash bid, more than there might usually be this time of year. And that can be exacerbated, and it might kind of hinder your typical seasonal trends. I mean, even if you look at, back testing seasonal trends, there's always the odd year outlier that didn't fit into the picture. And I'm just saying that this could be one of those.
Absolutely.
Just because there's a fundamental, difference. We have a little bit different fundamentals. So this is just in a graph. Sometimes I like to look at a chart of numbers in a graph, and you can see how the cash prices up in the Northeast just took a nosedive as soon as that OFO came out, and the issue on up and around northern Pennsylvania on that pipeline. So, and they rebounded a little bit today. I think the force majeure is ending. However, the repairs are projected to carry out until around the 19th of October. So it's certainly something to watch, especially when it's almost like this year in natural gas, it's like cramming for a test in the last minute.
Mm-hmm.
We're cramming to get molecules in the ground in this last month here, the next 5 weeks. And like today's number, 5 or 6 over expectations. Let's just be generous and call that a B a day, more than we thought. I mean, we have like 35 to 40 days left of injection season. But let's say we did another B a day or 2. And from now until the end, you're 40 or 80 more. I mean, it doesn't change the picture that much. It might change your feelings about what will be available this winter, but it doesn't change the picture that much. So a lot of things, a lot of forces finally are pushing and pulling on the market. And it's a market that has not spent very much time above $3. I think we had a little bit of a range at the beginning of this year where we were kind of popped into between 320 and 330. But other than that, the market it gets really nervous up here because it looks around for evidence that the market is strong, and it usually looks to the cash markets for that. And we're not into winter, weather yet. So I think expect volatility, and imply, and it's exactly why implied volatility blew out this last week. I mean, I think last week when we were talking about November, the implied vol was around 26%. And I think it got up to 33% or 32 yesterday and this morning. So just don't reach for, those big calls when volatility is exploding like that. Wait until you get some of these dips and you can get back into it. Because like I said, I think whenever the market sells off, the volatility sells off.
Right.
So you'll get a better chance to get in and out. And it'd be hard to imagine that we just go straight up from here. I think there's a lot of different forces, and there's still enough time left so you don't need to just completely load the boat. You can be a little bit more careful and not reach for those upside, that upside exposure in the market on days we're rallying.
Yeah, and it's also potentially an opportunity if you happen to be long to maybe even look for ways of financing it and selling some premium against the long position as the volatility explodes higher.
Absolutely. I mean, people start paying I think above 50% volatility for, $2 out of the money calls in January and February. It just gets crazy. It's like, I think you could probably come up with a better strategy than that, right? Buy a put and buy some underlying. You might be better off. But this next graph here is just showing, there was a few years ago, it was in October, and I'm trying to remember what year it was, where all of a sudden cash prices in the Houston Ship Channel went incredibly bid, and it drove the, I think, November contract almost up $1. And I've got to go back. I think it was 2 years ago. It was probably 2. And if you're looking for, some similar signs like that, you can see that prices, that's the orange line on this graph, prices at the ship channel really did start pulling away from Henry Hub this week. And, that's a huge demand area, very industrial, right? Very heavy into, chemicals and different processes. So if that continues, then I might say we could see a much more significant rally here. So it's keep an eye on, those cash prices in and around the Houston Ship Channel. I'd say it was LNG exports, but Cove Point is down for maintenance until October 11th. So, that's some demand that's off the market. So it's a little peculiar to see those prices they generally tend to trade fairly flat to Henry Hub. So that could be a sign of some underlying demand starting to pull on this. And then just along those lines of volatility, I think I'll just leave it with this. Here, let's take this chart. If you look at the structure of the futures curves, it's really the Jan and Feb and to some extent the December contracts that are really meaty. You got Algonquin trading at almost 1250, up Techco M3, which serves the Pennsylvania, New Jersey, Maryland ISO power pool, and also all those customers. That's up above 650. And then you have the Henry Hub just kind of making its little 20-cent rally. And the thing is, these futures now you wait all summer for you to get into the delivery window of these various basis futures, and they're going to start to get really, really volatile as people start to get some clarity and some opinions on whether or not they think a $12 product makes sense for this winter. And if that continues to move up, I think that could make things very interesting. But this is when the volatility kind of across the whole curve happens. The other interesting thing about this is the Feb March. So you can see kind of the structure, and let's just call it the structure of the Northeast curve between Jan, Feb, and then dropping off in March. It's actually the Feb March spread is much wider than March, April. And it's following the structure of the LNG, the Asian LNG market. And I think if you take a look at the Feb March spread, and we talked about this maybe 2 or 3 weeks ago, that might be the spread to watch versus the March April spread from a widening standpoint. And sure enough, it's out almost 10 cents. Now, just since the beginning of the month, we went from trading around a dime, Feb over, right, to Feb now almost 22 cents over, although I haven't looked at the screen in the last 20 minutes, so it could be different. And I bring that up because I think that might be the new March, April this year. And so I'd look for any pullbacks on that, which should come from pullbacks in the market in general, to maybe get back into that spread. Because I think that might become that might become the bullish indicator this year versus March, April, which just, if we think we're going to end the year with such low storage, April gets so bid because they got to start putting cash in the ground, and they got to start, upping their, renewing their summer storage contracts. And that spread tends to just end up getting flat at delivery. So it's better to trade a spread within the delivery or the storage season. And so I'll just say I'm looking at getting into this one and on any pullbacks if we get one. I think I'll just maybe, I think, unless you have any questions, Mike.
No, it's been a volatile few weeks in nat gas, and you went over a few different things, which is really interesting. I guess the one question would be, what's your thoughts here? Now we've seen the inventory figure, we've seen this run up. I guess you were kind of saying, and correct me if I'm wrong, you're bullish but wouldn't go chasing. You don't think it's going to be an explosive move higher, that sort of thought.
Yeah, I think we talked last week about the 310 level, and that if we can close above that, I like the market a little bit more. If we close below it, kind of back into the sell-off mode. So I'm using that level to, sort of get in and out of the markets. I feel like we could pull back below that, test it. I think there's a probability, but not because it's bearish, just because timing of getting into a seasonal play is difficult. And, the market likes conviction behind it. And that conviction is strength that you can see elsewhere. And the elsewhere would be cash, and cash would be strong due to, various operational things that are happening. So I don't think we're going to run straight up from here. I think I mentioned I'm long straddles. I was able to hedge some of them up on this run. I sold some higher calls. In a perfect world, we'd get a sell off and I could sell some lower puts and just kind of get it all framed in. I think if we get above 330 and close above there in the November contract, that could be the next, big signal.
Interesting. Well, that's definitely, we'll keep a close eye on that. Nat gas has definitely jumped back to the top of people's radar because of the recent vol. I mean, it was just about, I don't even know, 14, maybe 10 to 15 trading days ago, probably 15, that we were trading 280, 283, something like that. So, we traded overnight 325. So some good volatility there.
Yeah, absolutely. And I think it will continue from now until the end of the year, just as the weather starts to crystallize and have its impact on what's in the ground. And it will be interesting to see how come November, after the first couple of weeks of November, when we really are in withdrawal season, what sort of choices people make in the cash market versus drawing from storage. I think that's going to be very interesting to see whether or not they try to hoard their storage at the start of the season and bid up cash a lot more. So yeah, a lot of good, interesting moves from now till the end of the year. But like, it's not going to be one-way elevator to the top.
Yeah, well, absolutely. And we'll keep an eye on it. Please keep us posted in the chat, as you always do. And we'll speak with you soon.
Will do. All right.
All right.
Good trading,
Thanks, Brynne.
everyone.